one of the most powerful but lesser known retirement tactics is a concept that I call the three buckets. And what the three buckets really stand for is what proportion of your retirement assets are going to be in taxable accounts, things like a traditional bank account. What portion of your tactics are going to be in what I call a tax me later account, things like traditional IRAs and traditional 401ks. And then what portion of your retirement accounts, retirement money, is going to be in what I call a tax me now, but not later account, which are the Roth versions of the 401ks and the Roth version of the IRAs. And why is this important? And the reason it's important is because in many ways it allows you to control the tax rate that you're going to be paying in retirement, and specifically allows you to take advantage of the lower tax brackets. So, one of the rules of thumb that many of us heard as we were growing up is put as much money, save as much money as you can in a 401k and an IRA. And I think the reason we heard that is first, there's an employer match often with a 401k, and it's hard to beat that. So it probably makes a lot of sense to put money in a 401k up until the employer match. But above that now, you have three different places you can put your money, right? You can put it in a tax me now, but not later, which is a Roth. You're not going to get a tax break for that. Or you can put your money into a regular 401k and a regular IRA, which is a tax me later account, right? If you put your income into that, the government's going to put that money into the 401k or IRA on a tax deferred basis, so you don't have to pay the tax as you earned it, the ordinary income tax as you earned it. And then you have just a taxable account, which would be like a regular account at a bank account, or maybe a taxable account at Fidelity and Schwab, or a custodian like that. And those are kind of the tax me as I go accounts. And thinking through strategically how much money you want to have in each of those accounts can really make a big difference. And let me give you an illustration as to how it's powerful. Let's say when you're retired, I'm going to make a very simple example. I'm going to assume you have no Social Security and no pension, no other source of income. Your only source of cash flows is going to be from these three buckets. And I know that's not realistic. I know, most of us have Social Security, some of us have pensions, but just so that you get the point of what you can do. If all of your money is in a traditional IRA or a traditional 401k, as you take that $100,000 out, the government is going to tax that as ordinary income. Now, I'm not an accountant, and I do recommend you work with a professional in something like this, either an accountant or a fee-only financial advisor, which you can find just by Googling that term, to find one to work with you nearby. But this is just information so that you can begin your exploration on this. So getting back to that $100,000 a year in cash flows, if it all comes out of the traditional IRA, traditional 401k, it's going to be taxable. And that can put you in a pretty high tax bracket. Now, let's say you have two accounts. You have your tax me as I go account, which is just a regular taxable account like at a bank. And then you also have your tax me later, the traditional 401k IRA. And let's say you look at the tax tables and you say, boy, the tax rate on $25,000 ordinary income is pretty low. So you take $25,000 out of your tax deferred tax me later account, the traditional IRA 401k. Sorry, I'm kind of losing this. I hope I'm not losing you. But you take the $25,000 out, that's going to be taxed at ordinary income, but at that lower tax rate. And you take the other $75,000 out of your bank account, where your bank account is tax me as I go. I mean, if you just have a regular FDIC insured banking account. So that allows you to take advantage of some low tax money and still get your $100,000. Now, you take this one step further, and now let's say you have three accounts. And in those three accounts, you say, I need $100,000. So you take that, still the low tax rate of $25,000 out of your tax me later account, your traditional IRA. And let's say you take $50,000 out of your bank account, which is not going to be taxable income, and you take the other out of your tax me now but not later account, well, you got tax on that when you put it in, but all of that money is not going to be taxed now on the way out in general. Again, talk to an accountant. So that's the basic strategy. It's super powerful to have these 3 buckets. It allows you to do a lot of things that if you don't have 3 buckets that you can't do. So I think it's helpful. Another thing I want to mention with the tax me now but not later, the Roth version. When I say tax me now, it's, when you're putting some of your salary in, you're still going to pay ordinary income tax. You're not going to get that tax break on the money that you put in. But one of the really powerful things with the Roth version of an IRA is you don't have to pay what's called required minimum distributions, RMDs. So in a regular 401k, in a regular IRA, you have to pay, as you get older, in your 70s, you have to take required minimum distributions. And it's high level, the required minimum distribution is basically the inverse of how many years the government thinks a person of your age and gender has to live yet. So if the government thinks you have about 10 years, if your lifespan is about 10 years, in general, high level, then the required minimum distribution is going to be around 10%. Well, just again, for easy math, if you have $1 million IRA, and I know most of us would be like, boy, I'd love to have that problem. But just for the sake of illustration, if you have $1 million in your traditional IRA and you have to take 10% out, well, that's $100,000, and that can bump you into high tax brackets. The nice thing about the Roth version of that IRA is there is no required minimum distribution, right? The government would actually prefer that you take that money out sooner rather than later because it's growing tax-free. They'd love for you to take that money out and put it in your taxable brokerage account or your bank account and start paying tax on the gains. But you paid your dues, you paid the piper earlier when you first put the money in, and now the magic is letting it grow tax-free. So it's a really powerful tool for planning in retirement. And the Roth versions of these tools, not just the IRA, you should know, if you don't know, it's important that you know that many companies offer a Roth version of the 401k. So you can kind of supercharge the amount of money that's in this Roth wrapper that gives you these magical benefits. But the Roth, for a variety of reasons, tend to be really helpful and really beneficial as an estate planning tool. If you're planning on leaving any assets to your kids, a Roth IRA can be a really powerful way to do that. So if you'd like to see a video on that, let me know in the comments. Do me a favor, hit the like button. It really does help other people find this channel and benefit from videos like this as well. And until next time, I'm Azul, encouraging you to take full advantage of the youth of your senior years. Remember, you're only young once. Use this time wisely.